Assalamualaikum and hello. This video is gonna be explaining about finance for small and medium-sized entities. So, what is an SME? It is generally accepted that an SME is something larger than those businesses that are fundamentally a vehicle for the self-employment of their owner. Equally, an SME is unlikely to be listed on any stock exchange and is likely to be owned by a relatively small number of shareholders. Indeed, very often, the majority of the shareholders come from one extended family. Hence, the term SME covers a very wide range of businesses. Back in the 14th century, the development of the Malayan economy directly involved the trading of several commodities, mainly porcelain and spice. In the 17th century, the Malayan economy was mainly focused on producing global commodities, rubber and palm oil. The economy of the country continued to be community-based after achieving independence in 1957 until the 1970s. At that time, SMEs in Malaysia largely involved in agriculture and small services such as wholesaling, retailing, and restaurants. After the 1970s, diversification of the Malaysian economy from the mining and agricultural sectors to manufacturing activities led to strong economic growth. As a major exporter of tin, rubber, palm oil, tropical timber, and petroleum, together with the fast developing manufacturing sector, Malaysia was widely recognized as one of the most successful countries in the world. The manufacturing sector contributed to an increase in Malaysian exports, especially of electrical and electronic products, and become the key factor in sustained rapid economic growth. This economic transformation led to the establishment of many SMEs in the manufacturing sector. However, the development strategy for SMEs during that time mainly focused on the domestic-oriented market, small-scale industry, and in particular, the creation of the Bermitra Commercial and Industrial Community. In the mid-1990s, the functions of SMEs in the development of the Malaysian economy became more significant. Due to the Asian financial crisis in 1997 to the 1998 and the force of globalization, these enterprises were marked as a means for generating domestic-led investment, stimulating economic expansion, and increasing job opportunities in the country. Subsequently, SMEs have been transformed and strengthened as a mechanism to encourage domestic investment, whilst providing significant links in the development of a broad-based, globally competitive industrial sector. To date, with the support from the Malaysian government, SMEs have grown tremendously, encompassing various activities. Rather than focusing on manufacturing and agricultural activities, the enterprises are also extensively involved in service activities and have proven to be resilient in the changing business environment. Financing needs of SME. One of the biggest challenges of SMEs is making sure you have enough money to see you through the challenging first months. Without adequate financial resources, your business will have a hard time finding its footing. Entrepreneurs also need to be realistic about how long it will take for revenues to catch up to costs. You may have to endure losses for 1 or 2 years, perhaps even longer, and you will need money to tide you over. To ensure you have adequate funds, it's important to estimate your financial needs before starting a new business. The first step is to figure out your expenses. This can be divided into one-time startup costs and recurring expenses. Financing problem of SMEs. The first one is securing initial funding. The failure of many new businesses can be directly tied to initial undercapitalization. Having a great idea is not enough to ensure that the economy will survive. In some cases, businesses fail to launch because the owners run out of funds. Fortunately, initial undercapitalization can often be prevented through careful planning. Reasons that businesses are undercapitalized include poor planning, unexpected expenses, business startup delays, and investor or lender pull out. Poor planning. While there is something to be said for taking a just-do-it approach to starting a business, failure to plan for business expenses is one sure way to guarantee that a company will collapse, sometimes before it officially opens for business. The next one is unexpected expenses. In the early stages of a business, even a relatively small expense that is not accounted for in the company's budget can make it difficult to pay bills or make payroll. Next, business startup delays. Many businesses encounter delays while getting started. It may not be caused by any mistakes made by the owners, but out of an entrepreneur's control, such as license, permits, and construction issues are often. The last one is investor or lender pull out. Many new businesses rely on financing from lenders or outside investors. Unfortunately, lenders may reverse a loan officer and investors may decide to pull out of a venture at the last minute. The second one is affording quality staff. In a competitive job market, it is difficult to attract top talent. Startup companies often have additional difficulties because they often cannot afford high salaries or particularly appealing benefit packages. Unfortunately, these difficulties can force new business owners to hire less skilled, less competent employees. The third one is over-reliance on credit. Some new businesses rely on business credit cards and in some cases, the personal credit lines of its owner. If a company cannot pay off credit card debt right away, the interest on card balance increases. This can severely burden the business at a time when it should be growing. The fourth one is the ability to test new ideas. Uncertain cash flow can lead to significant financial management issues in small-scale enterprises. When a company does not have a healthy cash flow, it may have to forgo new opportunities, so current financial obligations can be met. Unfortunately, this may mean that the business never realizes its full potential because the owners can take potentially lucrative risks. Measures to ease the financing problems of SMEs. The first one, venture capitalists. Most major providers of finance have specialist venture capital funds. They provide capital often up to 5 years for startups and high-growth companies in return for an equity stake. Second one is banks. With little security and banks being risk-averse, often guarantees over the loan are needed. The third one, government solutions. Governments have adopted a two-pronged response to increasing the attractiveness of SMEs, increasing marketability of shares and tax incentive for investors. The fourth one is making shares marketable. The development of small firm markets such as the AIM in the UK and the growth enterprise market in Hong Kong is designed to bridge this funding gap and provide both a venue for further fundraising for SMEs. Next is business angel financing. Business angels are wealthy individuals who invest in a startup and get shares in the startup. This is therefore a high risk for an angel and so high returns are needed, meaning it can be expensive for the SME also ultimately. They offer expertise and further funding as the company grows. Government aid. Governments can encourage new business by guaranteeing loans for SMEs with insufficient security, although the SME will pay a premium for this. The last one is grants. Governments can also offer grants, for example, employing staff in certain industries and regions. There is also the possibility of small startup loans and tax incentives. Source of financing and the financial impact of different sources of finance on SMEs. The first one is personal, family, and friends. This is potentially a very good source of finance because these investors may be willing to accept a lower return than many other investors, as their motivation to invest is not fully financial. However, this is somewhat limited. The advantage is that it shows the owner has some level of confidence and commitment to the business enterprise and might make it easier to gain money from others. The disadvantage is there is a higher risk of the money being lost, since the entrepreneur idea might not be fully developed. The second one is trade credit. SMEs, like any company, can take credit from their suppliers. However, this is only short-term, and indeed, if their suppliers are larger companies who have identified them as a potentially risky SME, the ability to stretch the credit period may be limited. The advantage of trade credit. By setting up trade credit, it will require less money to start up a business. This can be really important to those who have little capital in starting up a business, but also the ability to buy now and pay later. The business can purchase the item and sell them at a profit before payments are made. The downside of trade credit is if the business fails to meet the deadline, it may lead to poor credit history, which might limit this business chances of securing funds elsewhere. Bank overdraft. An overdraft is agreed sums which a customer can overdraw from his current account. Bank overdraft can be a good source of short-term finance to help a business with seasonal shortage of funds that does not require long-term solution. The charges varies and are linked to the bank rate. The advantage of overdraft is that it is always there when it is needed, and it is at no cost. However, small fees are charged. It helps to maintain a good cash flow. Also, it is quick to set up when compared to a loan. The disadvantage is that the interest rate on an overdraft can be quite high, especially for small firms where the risk to the bank that they might not get their money back is greater. In addition, the business is not allowed to exceed their overdraft limit. If they do, the bank might refuse to pay checks to creditors and may hit the business with a hefty charge for exceeding the limit. The next one is bank loan. A loan is an amount of money borrowed for a set period with the aim of paying back at an agreed date. The repayment will depend on the size, length of the loan, and the rate of interest. The term and conditions of loan vary with providers and may be negotiable. Loan periods vary between 1 to 10 years, with some going up to 20 years. The riskier the business, the less likely to be able to borrow and the higher the interest rate charged. This helps the bank to ensure that they are covered even if the risk does not pay off. Advantage of loans is that banks' loans are reliable because the money is guaranteed throughout the agreed period, generally 3 to 10 years, unless there is a breach of the loan conditions. Disadvantage of loans is that most loans are not flexible once the payment dates are fixed. Also, they have strict terms and conditions. There might be difficulty in making monthly repayment when customers don't pay on time, therefore causing cash flow problem. Business angels. A business angel is a wealthy individual willing to take the risk of investing in SMEs. While limitation is that these individuals are not common and are very often quite particular about what they are prepared to invest in. One of the advantages is that they often make quick investment decisions without complex assessments. The disadvantage is that they are difficult to find and don't make investment very regularly. More time will be spent with the business angels rather with the business giving information. Venture capitalist. A venture capitalist company is very often a subsidiary of a company that has significant cash holdings that they need to invest. The venture capitalist subsidiary is a high risk, potentially high return part of their investment portfolio. Hence, many banks will have venture capitalist subsidiaries. One advantage of getting a venture capitalist is they provide large sum of finance and the significant expertise, contacts, and experience they have acquired while running other businesses. Furthermore, successfully attracting venture capital makes it sometimes easier to get others for further funding. On the other hand, the disadvantage is that getting a deal with a venture capitalist may be a long and difficult process, as it will require drawing up a well-detailed plan, financial projections which may require professional help or friends who have such knowledge. Legal requirement may be needed on getting to the negotiation stage. All of these services will have to be paid for whether or not the fund was secured. Also, there is a tendency for venture capitalists to influence or take control of the business. Next is equity financing leasing. Leasing assets rather than buying them is often very useful for an SME as it avoids the need to raise the capital cost. However, leasing is only really possible on tangible assets such as cars, machines, and others. Some of the advantage is that having and using an asset without having to pay the full cost upfront, so cash can be diverted for other purpose. It gives the business access to a modern standard of equipment which might be too costly to buy. Upfront payments are spread over a long period of time. Leases can be helpful to business which carries out short projects or needs equipment for a short time, as they don't have to buy such equipment outrightly. Some disadvantage of leasing equipment is it can work out to be more expensive than if you buy the assets outright. Capital allowance may not be claimed on lease equipment less than 5 years, in some cases 7 years. Factoring and invoice discounting. Both of the sources of finance effectively let the company raise finance against the security of their outstanding receivables. Again, this finance is only short-term and is often more expensive than an overdraft. However, one of the features of these sources of finance is that as an SME grows, their outstanding receivables will grow, and so the amount they can borrow from their factor or from invoice discounting will also grow. Hence, factoring and invoice discounting are two of the very limited number of finance sources which grow automatically as the business grows. The major advantage of this source of finance is the quick availability of funds, which can be channeled into another aspect of the business. But also with the presence of manufacturing companies, this makes price competitive. Further, it makes preparation of financial planning and cash flow easier and smoother. The downside is that the charges will imply a reduction in the profit margin. In addition, it may limit the way business is done, as the factoring company may want to vet their consumers. Crowdfunding. Crowdfunding involves funding a venture by raising finance from a large number of people and is very often achieved over the internet. Crowdfunding has the potential to be very beneficial to SMEs. It allows them to contact and appeal directly to investors who may be willing to take the risk involved in funding the new technologies and innovations, which SMEs are often good at producing. The disadvantage is that if the target amount isn't reached, potential investors get their money back and the business goes away empty-handed. Failed project is damage to the reputation of the business, and people who have pledged money to them and getting the rewards or returns wrong can may give away too much of the business to investors. Supply chain financing. In supply chain financing, the finance follows the value as it moves through the supply chain. It is relatively new and is different to traditional working capital financing methods such as factoring or offering settlement discounts because it promotes collaboration between buyers and sellers in the supply chain. The advantage for the suppliers is that it is a useful tool for the supplier if used properly. Suppliers value early payment, allowing them to maximize cash flow and fund organizational objectives such as expansion and acquisitions. One of the drawbacks of supply chain finance can be the cost and complexity of the solution. It can be difficult to understand the details of the agreement as well as how discounts and the corresponding rate might be applied by the buyer.